In this presentation, we will take a look at multiple choice questions related to financial statement analysis, going through those questions and then practicing test-taking skills with them. First question, dividing accounts receivable net by net sales and multiplying by 365 is either A, profit margin, B, days sales uncollected, C, accounts receivable turnover ratio, D, average accounts receivable ratio, or E, capital turnover. Go through this again using the process of elimination. Dividing accounts receivable net by net sales and multiplying by 365. So what we have here is we've got the accounts receivable. We're talking accounts receivable. It's net. That means that it's going to be net of the allowance for doubtful accounts typically. And then we've got the net sales. So we've got the net sales, which is not net income. That's the top line of the income statement, net of the contra sales accounts, such as an allowance, such as the returns and allowances and any discount type of accounts. So it's really basically the sales number. And then we multiply it times the 365. And anytime we see 365, or if someone tries to round it to 360, if we see 360 or 365, we think, oh, that's the number of days in a year. You just got to kind of know that number. That really should trigger that in your mind. And then if we say, well, that's the days in a year, then you're probably thinking that you're looking for something over days, right? That's what we would probably be considering. So A says the profit margin has nothing to do with accounts receivable, the profit margin. So that doesn't seem like it would be one of them. B says days sales uncollected. 365 days, you would think maybe that might be one of them because it's got the days thing in there. C says accounts receivable turnover ratio, which is a very common ratio. So if we don't know them, we'd say, Matt, it's got accounts receivable in it. I know that's one of them. So I'll keep that one now. The second says average accounts receivable ratio. That's not really a ratio, kind of. I mean, we do take the average accounts receivable for some of our ratio analysis, but the average receivable itself is not typically one of our end analysis goal. And then the next one says capital turnover, and that doesn't seem to have anything specifically to do with receivables. So let's keep it with B and C. Go through it again, dividing accounts receivable net by net sales and multiplying times 365. Is that B, days sales uncollected, or C, accounts receivable turnover ratio? And note here again, because we're breaking this down into the number of days, it seems even if we didn't know, we'd go, 365, maybe that's breaking it down into the number of days, which would be the B. So final answer, B, dividing accounts receivable net by net sales and multiplying by 365 is B, days sales uncollected. Next question. Dividing ending inventory by cost of goods sold and multiplying times 365 is either A, inventory turnover ratio, B, profit margin, C, days sales in inventory, D, current ratio, or E, total asset turnover. Let's go through this again using the process of elimination. Dividing ending inventory by cost of goods sold and multiplying times 365. So we've got the inventory, we've got the cost of goods sold, and once again, we've got that 365 type thing going on here, which would think might have something to do with days that we have, possibly days that the inventory is on hand and not being processed over, how long we have the inventory before sales possibly. So let's go through this. A says inventory turnover. That's going to be one of our ratios that sounds familiar, and it's got inventory in it, so I'll keep that. B says profit margin, which doesn't necessarily have anything to do, possibly with inventory. It's got, cost of goods sold in it, but doesn't seem like the one. C says days sales in inventory. That's got our days in it, and it's got inventory. That seems reasonable. D says current ratio, and that should be the most familiar ratio to most people. And it's got total current assets and liabilities. Doesn't seem right. And then E says total asset turnover, which seems too broad. That sounds like a familiar ratio, but it's too broad to be thinking about just inventory, so that doesn't seem right. So I'm going to keep it with A and C. Go through it again. Dividing ending inventory by cost of goods sold and multiplying by 365 is either A, inventory turnover ratio, or C, days sales in inventory. Of those two, I would go with C, even if we didn't know really exactly what it was, because the 365 would indicate that we're doing something over some amount of days sales and inventory. That seems appropriate. So final answer, C, dividing ending inventory by cost of goods sold and multiplying time by 365. C, day sales in inventory.